Usually when you were holding a compass, you expect the needle to just, well, point north.
Right. It's a reliable rule. You don't even really think about it.
Exactly. You trust the instrument, you trust the magnetism of the Earth, and you just follow the path. But imagine you are navigating through a dense forest. You look down and suddenly your compass violently swings south.
Oh, wow.
It-
Yeah, that would be completely disorienting.
Right. You are suddenly forced to question either the instrument you are holding or, the very ground you are standing on. It's this moment of profound navigational panic.
And I mean, what makes it even weirder is if you look around at everyone else's compasses and theirs are working just fine.
Yes. And if you have been watching global markets this month, and keep in mind, it is early May 2026.
Okay.
Right now, something incredibly weird, a true anomaly is happening down in the Australian economy.
It really is. It's a striking divergence.
Yeah, that compass swinging wildly in the wrong direction.
Yeah.
That is the Reserve Bank of Australia. We've got a really thick stack of sources today, a whole set of recent macroeconomic research notes, plus some structural analyses from, right now in May 2026.
Great data in there.
Really good stuff. And our mission for this deep dive is to decode what the sources are calling the Australian anomaly. Because right now, while the rest of the world is, well, cooling down, Australia's central bank is essentially fighting a raging economic wildfire.
They are entirely out of sync with their peers.
Completely. And for you listening, whether you are trying to understand the ripple effects of global monetary policy, or maybe you were looking at real estate investments, or honestly just trying to figure out why your groceries and rent are so expensive lately.
Which is everyone right now.
Right, exactly.
Yeah.
Australia serves as a perfect high-stakes case study. It's a masterclass in what happens when deep structural vulnerabilities collide head-on with global shocks. So, okay, let's unpack this because the contrast here is just staggering.
Where do you want to start?
Let's set the stage with global interest rates, just to get a baseline. Right now, the U.S. Federal Reserve is sitting comfortably around 3.50 to 3.75%.
Yep, they're definitely cooling off.
We see the exact same cooling trend with the European Central Bank, the Bank of Canada, and even the Reserve Bank of New Zealand. But the Reserve Bank of Australia, the RBA, is sprinting in the complete opposite direction.
Literally the opposite.
Yeah. They've pushed rates to 4.90%, and the markets are pricing in a near certain hike to 4.35% by May 5th.
And the structural analysis from this month suggests they might even peak up to 4.85%.
Wow.
Yeah. What's fascinating here is that we are not just looking at a slight deviation in the timeline. This is a massive fundamental policy divergence. The RBA is essentially being forced to be aggressively hawkish right now to repair its own credibility.
Its credibility.
Yeah, because to understand why they are so aggressive today, you have to look at the massive misstep they made last year in 2025.
Ah, right. The research notes really harp on that 2025 misstep because it is brutal to look back on.
It really is.
Last year, the RBA actually cut rates 3 times, bringing them down to 3.6%. And they did that because inflation had temporarily dipped. It dropped to 1.9%.
Which is right in that target band.
Exactly. And I imagine there was an immense amount of political and public pressure to offer some relief. It looked like they had beaten the inflation dragon, achieved that mythical soft landing, and could finally take their foot off the brake.
But it was a temporary illusion.
Yeah.
Central banks always want to orchestrate that perfect soft landing, so when they saw that 1.9%, they declared an early victory, mostly to avoid tipping the economy into a recession.
Sure, that makes sense at the time.
But the result of that premature easing was just disastrous. The raw data in our notes shows we got a severe V-shaped inflation spike.
Right, V-shape, meaning it went down and just instantly bounced back up.
Exactly. Within just 6 months of those rate cuts, inflation rocketed right back up from 1.9% to 3.8%.
Wow. That is incredibly fast.
It is. And when inflation rebounds that violently, it does psychological damage. It deeply entrenches inflation expectations.
People just assume prices will always go up.
Yes. People and businesses start to believe that high prices are just the permanent new normal. So they adjust their pricing and their real demands accordingly. It becomes a self-fulfilling prophecy.
Okay, but I had to push back a little here, or at least ask the question I think everyone is thinking. Was it really a mistake at the time?
How do you mean?
I mean, weren't they just following the global trend? Because the way I read the data, it feels a bit like taking antibiotics.
Okay, I like that analogy.
You get a chest infection, the doctor gives you a 10-day prescription. On day 5, you feel great, so you just stop taking the pills.
Right, which you are never supposed to do.
Exactly. Because you stop early, the economic infection, the inflation in this case comes back twice as strong, and now it's resistant to the original medicine.
That is spot on. And the danger of stopping that economic antibiotic early is that the macro environment wasn't actually healthy yet.
Right.
It wasn't operating in a vacuum. It was operating in an economy with severely constrained supply. So when the central bank lowered rates, they instantly reignited consumer and housing demand. Money became slightly cheaper to borrow.
But there was nothing for them to buy.
Exactly.
Yeah.
There was no new supply of goods or homes to absorb that renewed demand. More money chasing the exact same amount of stuff immediately equals higher prices.
Which is why the current RBA governor, Michelle Bullock, is now forced to overcorrect.
She has no choice.
She has to hike rates aggressively to send a severe, unambiguous signal to price and wage setters that the central bank is serious and that they will crush demand if they have to.
Yep.
Which actually transitions us perfectly into the most visible symptom of this entire policy failure, the housing market.
The housing data in these notes is just wild.
It is. Why did those early rate cuts trigger such a massive instant inflation spike?
Yeah.
It's because they poured gasoline on a market that was already experiencing a historic, catastrophic collision between supply and demand.
Yeah.
The demand shock here is just hard to wrap your head around. In the 12 months leading up to January 2026, Australia saw a record-breaking net overseas migration of nearly 500,000 people.
That is 500,000 new people needing somewhere to live, essentially overnight. You are trying to build a brand new major city every single year just to keep pace.
And that massive demand crashed into an absolute brick wall of constrained supply. The Australian construction sector has been completely paralyzed.
Utterly paralyzed.
You have a severe shortage of construction workers, soaring material costs, and this is all culminated in a huge wave of builder bankruptcies, which honestly sounds completely counterintuitive.
It does sound weird, doesn't it?
Yeah. If demand for housing is at a record high, why are builders going bankrupt?
It comes down to the way the construction industry structures its contracts. During the pandemic and immediately after, a lot of builders signed fixed-price contracts to build homes. But then, the cost of timber, steel, and labor absolutely skyrocketed.
Oh, I see.
So they are legally locked into building a house for, say, $500,000, but it now costs them $600,000 to actually build it.
They're building at a massive loss.
Exactly. So paradoxically, at the exact moment Australia desperately needs builders, you literally have fewer construction companies capable of putting roofs over these new arrivals' heads.
Wait, but we're pouring 500,000 people into a country that physically cannot build homes fast enough. Surely, out of 500,000 migrants, a good chunk of them are workers, right?
You would think so.
So why doesn't that influx of people automatically solve the labor shortage in the construction industry? Why aren't we just handing the new arrivals hammers and hard hats?
Because of a profound mismatch in skills, coupled with the immediate nature of human needs.
Meaning what, exactly?
Well, the people arriving on various visas, students, tech workers, healthcare professionals, they don't neatly map onto the specific specialized trades required to build housing.
Right. A software engineer isn't going to suddenly start pouring concrete.
Exactly. Furthermore, when 500,000 people arrive, they need a bed, a roof, and a bathroom on day one. But you cannot build a house overnight.
Especially not with the current red tape.
Right. Especially in Australia right now, where regulatory and planning delays are notoriously long. It can take years just to get the permits to break ground. So the demand is immediate, but the supply is incredibly sluggish.
The result being that vacancy rates have plummeted to near historic lows. If you're trying to rent an apartment, there's simply nothing available, so landlords can charge whatever they want.
Supply and demand at its most brutal.
And the direct economic consequence is that in the first quarter of 2026, housing inflation specifically skyrocketed by 6.5% year on year.
Housing has become the single most persistent, sticky driver of core inflation in the entire country.
And that is just a domestic fire burning. But it's not just the domestic pressure, right? The global picture made things exponentially worse. Which brings us to Australia's unique vulnerability to global shocks compared to its peers.
Yes, the external shocks.
Right, the early 2026 external shocks. We had massive geopolitical conflicts in the Middle East, specifically involving Iran, which choked global supply lines and pushed Brent crude oil prices above $110 a barrel.
Which is a huge spike.
It is. Now, normally you think, okay, global oil shock, everyone on the planet suffers equally. But Australia has a very strange paradox here.
It is a massive structural flaw because Australia is one of the world's biggest exporters of coal and natural gas. They are incredibly energy rich.
Right.
But despite that incredible wealth of fossil fuels beneath their feet, they import over 90% of their refined fuels.
Wait, 90%?
Yes, we're talking about the actual usable petrol and diesel that make the economy physically run.
It is such a bizarre scenario. It's like owning the largest, most productive apple orchard in the world, but having to pay exorbitant premium prices to import apple juice from across the ocean because you don't own a single blender.
That captures the absurdity of it perfectly.
It's crazy.
Over the last decade or so, Australia closed down almost all of its domestic oil refineries. The logic at the time was purely financial. It was simply cheaper and more efficient to import fuel from massive mega refineries in Asia.
A short-term efficiency play.
Exactly, which created a long-term strategic vulnerability.
And the damage from this lack of, blenders is wild. When you look at the figures in the notes, there was a 32.8% month-on-month spike in petrol prices in March 2026 alone.
Massive.
And that one shock drove a huge 8.9% year-on-year surge in the first quarter transport consumer price index.
If we connect this to the bigger picture, the contrast with other nations becomes really clear. Look at the U.S. and Canada.
Okay, how do they compare?
They are also massive energy producers, but crucially, they maintain robust domestic refining capacity.
Right. So when global crude oil prices spike to $110 a barrel, it hurts at the pump, sure, but their broader economies actually get a bit of a buffer.
Oh, because they were selling it at that high price.
Right. They get a fiscal windfall from exporting energy at those high prices, which offsets the domestic pain.
But Australia doesn't get that.
No. Australia, lacking that domestic refining capacity and having virtually no strategic fuel reserves to release in an emergency, absorbs the global price shock entirely as imported inflation.
And it's not just more expensive for you, the listener, to fill up your car to get to work. There's a brutal second-round effect that ripples through the entire economy.
The logistics network.
Yes. Diesel runs the trucks. The trucks move the freight. The freight supplies the grocery stores. The cost of literally everything on a supermarket shelf goes up because the physical cost of moving that item from a warehouse to the shelf has gone up.
Exactly. Imported inflation bleeds into domestic goods. And if you are out there listening and you are paying drastically more for housing and you are paying a premium for gas and groceries, you'd logically hope your paycheck is going up to compensate.
You'd hope so.
And the data shows wage growth actually is strong. But here is the twist. That strong wage growth is actually a huge part of the problem keeping inflation high.
It is. The labor market is exceptionally tight right now.
Let's look at the numbers. Unemployment is sitting at a very low 4.3%, and wages are growing at a very solid 3.1%.
Right.
On paper, if you are a worker, that sounds fantastic. You have a very low chance of losing your job, and you're getting a decent raise every year. Why are economists looking at this and hitting the panic button?
Because of what the businesses are actually getting in return for paying those higher wages.
Oh, okay.
It is disastrous for businesses right now because of a severe drop in productivity. When you examine the macroeconomic data, labor productivity didn't just stagnate recently. In the 2024-2025 financial year, it actually shrank by 0.6%.
Here's where it gets really interesting, because the math here is toxic. Think about it like having a local bakery.
Okay.
You are paying your baker 3% more every single year. But somehow, despite the higher salary, that baker is actually baking fewer loaves of bread than they did last year.
Right.
Production is going backward while compensation is going forward.
That baker analogy is the perfect way to explain what economists call unit labor costs.
Unit labor cost.
Yeah, it's simply the math of what a business pays for labor versus what actually gets produced.
Yeah.
If wages go up but the amount of bread baked goes down, your unit labor costs absolutely skyrocket.
Because each loaf of bread costs you more to make.
Exactly. And why is productivity falling? It's largely because businesses haven't been investing in better technology or equipment.
Why not?
For years, particularly during the post-pandemic recovery, the strategy was just to hoard labor. If you had a problem, you just hired another person.
Throwing bodies at the problem.
Yes, you threw human bodies at the issue rather than investing in better software or automation.
Okay, so now put yourself in the shoes of a business owner. Your labor costs are surging. And because unemployment is so low, you are already operating at maximum capacity.
You're stuck.
Yeah, you can't just easily fire your inefficient baker and hire a better, faster one because there aren't any available in the job market. So what do?
You have to raise prices.
Exactly. You have to protect your profit margins to stay in business. You pass those surging unit labor costs directly onto the consumer through higher prices.
And this dynamic is exactly what is keeping inflation incredibly sticky right now. It is particularly vicious in the services sector.
Like what kind of services?
Think haircuts, dining out, local logistics. These are non-tradable goods. You can't just jump online and import a cheaper haircut from overseas to force local prices down.
Right.
So the domestic prices just keep ratcheting up.
So what does this all mean? We have this explosive mix, a housing crisis fueled by 500,000 new migrants, hitting a wall of unbuilt homes and bankrupt builders.
Yep.
An energy paradox, where a resource giant is importing all its refined fuel at premium prices, a workforce getting paid more to produce less, and an aggressive central bank trying to fix a past mistake by hiking interest rates while the rest of the planet is cutting them.
Is mess.
If the RBA just keeps slamming the interest rate hammer to fix this,
Yeah.
who actually pays the price?
The households pay the price, and they pay it almost instantly.
Wow.
The immediate risks evaluated in the research paint a very painful picture of monetary tightening. Continued rate hikes are heavily stressing Australian households. The data suggests the current rate trajectory is adding roughly $90 to $150 to monthly mortgage repayments.
To understand the sheer panic here, you really have to look at how Australians borrow money compared to other places.
It's very different.
In the U.S., for example, if you buy a house, you typically lock in a 30-year fixed-rate mortgage. If the Federal Reserve hikes rates 10 times, you don't care. Your monthly payment stays exactly the same.
Sure.
You are shielded. In Australia, the vast majority of mortgages are variable. They are intimately tied to the RBA's cash rate.
So they feel every hike.
Yes. So when the central bank hikes rates on a Tuesday, millions of households see their bank accounts drained by hundreds of extra dollars on Wednesday. It is a direct, immediate hit to their disposable income.
And because of that extreme sensitivity to variable rates, the current policy path could push potentially 30% of Australian households into severe mortgage stress.
30%.
Yes. We are talking about families having to choose between keeping the lights on, buying groceries, or paying the bank.
That is a terrifying metric.
Right.
And beyond the household pain, the structural analyses mention that these high interest rates are keeping the Australian dollar very strong.
Which has its own ripple effects.
Right. It attracts foreign capital inflows, sure.
Yeah.
But a strong dollar makes Australian exports more expensive globally. That just further squeezes local businesses competing in export markets. Plus, with a cost of debt so high, it's creating massive equity volatility and freezing real estate investment. Investors don't want to build new apartment complexes if the financing costs are astronomical.
It freezes everything.
So, if the interest rate hammer is just causing immense pain without actually building homes or refining oil, how does Australia actually fix the underlying disease?
That is the ultimate crux of the issue. Monetary policy, meaning the RBA raising or lowering interest rates, is only ever a band-aid.
Right.
It is designed to manage demand. But the economic data makes it explicitly clear that avoiding permanent economic stagnation requires long-term supply-side reforms.
Because the Reserve Bank cannot physically pour concrete for new homes.
Exactly. And it cannot build an oil refinery.
So if the RBA's interest rate hammer only destroys demand, how do we physically fix the supply side? Earlier, we talked about builders being paralyzed by red tape. Does the government just need to get out of the way?
Absolutely. The first major structural reform required is sweeping deregulation.
Meaning cutting the red tape.
Yes. Australia needs to slash the red tape, particularly in construction, zoning, and urban planning. The current regulatory environment is stifling business vitality and competition.
Making it too hard to build.
If you want to fix the long-term supply constraints, you have to make it easier, faster, and cheaper for the free market to actually build and operate. You have to shorten the time it takes to get a permit from years to months.
Makes total sense. Get the bureaucracy out of the way so the builders can actually build. But what about the productivity problem? If we are stuck throwing bodies at problems, how do we fix the productivity side of the equation and stop that toxic unit labor cost spiral?
That requires what economists call capital deepening.
Okay, and if you're a consumer, Capital deepening probably sounds like dry academic jargon.
It does.
But what it actually means is that the guy making your coffee or the warehouse worker shipping your packages gets better software and faster machines. It means buying the baker a better automated oven instead of just hiring a second inefficient baker.
Exactly. Capital deepening means encouraging businesses through tax incentives or other policies to invest heavily in technology, equipment, and innovation.
Better tools.
Yes. To reverse the 0.6% contraction in productivity, you need workers to have better tools. You need technology to amplify human effort rather than just endlessly increasing headcount.
And the benefit there is.
When workers produce more per hour because they have better tools, businesses can afford to pay higher wages without having to raise prices on the consumer.
Got it. And finally, we have to talk about the raw math of the population surge. You can deregulate zoning laws all you want, but how do you actually reconcile 500,000 new people with the current housing deficit?
You need a dedicated, unshackled housing initiative.
You need real targets.
The government must set, and crucially, actually meet, aggressive housing construction targets to finally match that extreme population influx.
They just have to build.
The physical supply of homes has to rise to meet the demand of the new arrivals. If they do not solve the physical housing supply, shelter inflation will continually keep core inflation elevated, forcing the RBA to keep rates punishingly high.
Okay, to quickly summarize this journey we've been on today, Australia right now is trapped.
Very much so.
They are caught in a web woven from a premature 2025 policy error, a massive housing shortage driven by record migration crashing into paralyzed builders, a unique vulnerability to imported energy prices despite being wildly resource-rich, and a severe, stubborn drop in labor productivity.
This raises an important question, and it is something anyone analyzing global markets should really mull over.
What's that?
Central banks, like the RBA, really only have one tool. They have a hammer, and that hammer is interest rates. And what does a hammer do? It destroys demand. It breaks things to slow the economy down. But if Australia's true crisis is fundamentally a lack of supply, not enough houses being built, not enough refined fuel being produced, not enough productivity from its workforce, how much longer can the Reserve Bank of Australia keep using that hammer to crush household finances before the government is forced to step in and fix the actual physical constraints of the economy?
Wow. It's like holding that compass we talked about at the beginning, watching it spin wildly out of control. You can keep tapping the glass, hoping the needle magically resets to north. You can keep hiking interest rates, but eventually you have to stop blaming the instrument, look up, and realize you need to fundamentally change the ground you are standing on.
Exactly.
Thank you for joining us on this deep dive. Keep questioning the headlines, keep looking at the underlying structure, and we will see you next time.